Alright guys, so in this educational video, we're going to talk about the ICT Unicorn model. We're going to talk about the ins, the outs, what you're looking for, what PD arrays do you need to understand, and then also how you can phrase the highest probability setups, because a lot of people are talking about the Unicorn model. They don't give you examples, they don't talk about when it doesn't work, why it works more than others, in certain situations. And that's something I want to talk about today, because I think a lot of people get stuck in this, in pattern trading. And all pattern trading is exactly as the name sounds. You're looking for certain patterns, but that's all you're trading off. Now, is it going to work? Sometimes, yes. Can you phrase high probability trades if you have a narrative? Yes. Would I say you need to have a daily bias to trade the unicorn model? No. You can pair time, you can pair price without a daily bias, and just make sure you've got a clear narrative. Where should price head to, or why should price get to where you want it to go in the next 30 minutes or 1 hour? That should be your focus. Not where should price close in the day. But if you're trading a session and you're scalping, you're going for 10, 20, 50 handles, depending on the session you're trading, focus on the narrative. Focus on where should price be, or where do I want price to be in the next hour? And then next question you should ask yourself is, why should price get there? I'm going to make another video on this, on narrative versus bias, the way I kind of see the markets, and then how I phrase my own trades. But for now, let's talk about this model. You need to understand breaker blocks, and you need to understand fair value gaps. I think fair value gaps, a lot of people understand that already. Breaker blocks, people have different interpretations, and that's all I'm saying here, right? For me, the things I'm going to illustrate in this module, right, and in this PDF that I'm going through, it's what I've personally used and what I've personally seen to work, right? Just like people defining the Asian range. Some people define the Asian range as 8 till 12. I do it from 7 till 12. Some people do it 6 till 12. Whatever works for you, whatever you've seen repeat, that's what you should use, and that's what you should use moving forward. Now in this diagram here, there's a lot going on, right? There's a few PD arrays that we can talk about, and I want to talk about the typical, unicorn model, and talk about that here so we can discuss that. Now, diving deeper into this example, we can see, of course, right, price is stepping down, stepping down, stepping down, and then at some point in time, we have this. Now this here is just a smart money reversal. It's simply where price turns. When price turns, does price have to completely reverse 100 handles? No, but you should be looking for those setups that can reverse or retrace to a level that you're happy to take profits. So for me, if this was London session, I'd be happy to take it 10 handles. If that was 10 handles, I'm satisfied, right? If this was the New York session, I want to take it, say 30, 40 handles potentially. Maybe I'll take it to here. So you've got to phrase those setups, whether it's using the unicorn model or other PD arrays, to then take the price to a level that you're happy to take profits or to take partials. That's the first thing I want to phrase by saying, you got to be realistic about it. And when you have reversals or retracements, this is one setup that can occur, and this is the unicorn model. Now let's get into a bit of a deeper dive into breaker blocks, unicorn models, etc., etc. So what I've done here in this photo above, I've outlined a few different PD arrays, right? So obviously this green box from this candle's high to this candle's low, that represents a bullish fair value gap, right? Or a busy. Buy side imbalance, sell side inefficiency. The second thing I've outlined here is a green candle. I've included the wicks, and that whole candle there is a breaker block. But I want to talk about why that's a breaker block for me, right? Let's talk about this, right? There's a low formed here, there's a high formed here. There's a lower low that sweeps liquidity right here, and then there's a higher high that creates a shift in structure, right? So you're looking for that pattern. Technically, you've got a low, a high, a lower low, or just a rate of liquidity, and then you've got a shift in structure, and you're looking for a breaker block or part of that breaker block to line up with a fair value gap. That's really, really important, right? So if this is the breaker block here, you're wanting that to line up with a fair value gap. Now the question that you might have is, does all the breaker block have to line up with a fair value gap? No, right? You might have seen ICT talk about this himself. Even though part of that lines up with the fair value gap, that is still good. That is still good, right? But there's more going on here that we can talk about. So in this photo above, if I just zoom out a little bit just so we can get the text in and we can talk about it here. In the photo above, I've outlined two PD arrays. Again, the first is a busy and the second is a breaker block. You could use the bodies, but I use the whole candle. Really important, because this is on a 1 minute time frame. What that looks like on a 30-second could be different. So I'm outlining that whole range so I can use it as a range, and I can see if any portion of that lines up with that fair value gap. Again, I class this up close candle as a breaker block, as it's the last up close candle before a sweep liquidity, which we said, right? Sweep liquidity. And then we have, the shift in structure. I've also mentioned here that, you know, sometimes it can be tricky to identify breaker blocks when price has so many up close candles. So for me, I'll choose the one that stands out the most, right? So for example, here you've got these up close candles, this one here too. Doesn't matter which one you use technically, guys. Like, you could say that's your breaker, that's your breaker, that's your breaker. They technically still line up with the fair value gap, but the importance of this is understanding what the breaker block actually is, and then what's its function. What's it telling you about buyers, sellers, movement of price, moving up or moving down? And we get into that in a bit more detail as we go through. So that is the real important part. Not necessarily, oh, is this a breaker, that a breaker? What is a breaker? Like in its definition, raw definition, and what's it telling you about price action and where it might go. So let's get into that here. Let's dive a little bit deeper, right? Let's dive a little bit deeper. So I've labeled now a bigger price swing. So if I went back and I was going to label A, B, C, D, I'll label A here, B here, C here, and then D there. Right? I've done this on a bigger time frame using a bigger price swing, right? So I've labeled A, B, C, and D. Now, what I want to talk about is what is the function of up close candles in a downwards trend, and what is the function of down close candles in an upwards trend. When price is moving down, right, let me just zoom in again so you guys can see. When price is moving down like this, up close candles should act as resistance. Why? Because they act as order blocks, right? When we sweep liquidity, this up close candle should act as an order block, right? So as soon as price closes above that up close candle, that is telling us something about the shift in price structure. Now let's just take that a step further and let's look into this last example we talked about down here, right? A, B, C, and then D. That's a breaker block on a smaller time frame, and this is what I'd consider a breaker block on a bigger time frame, because if I zoomed out onto the 5-minute chart, this up here would be an up close candle, this whole thing, and all this price swing would be condensed. Right, so what I'm looking at is I'm looking at the major up close candles in different price swings, because again, guys, price is fractal, time is fractal. We could draw a line like this, go up, down, up, up, down, up, down, up, down, up, down, up, down, up, down, up, down. That's like an internal swing of price action, right? The highs and lows. Or we could get more of an external picture and go low, high, low, high. You get me? So you're going to have smaller price swings inside of bigger price swings. Both the smaller price swings and the bigger price swings have those up close candles, of which they could line up with a fair value gap, meaning they could be a breaker block. Right, keep that in mind. So this here is now just on a bigger time frame. So we've got a low, we've got a high, we've got a lower low that sweeps liquidity, right, on a higher time frame, and then we've got a higher high here that sweeps the top of this candle, which causes a shift in structure. When price returns back into this bullish gap here, from this candle's high to this candle's low, that perfectly lines up with this up close candle, and that line really should be at the bottom of that candle. And so that there provides you an entry to go long. Keep that in mind. So that's kind of what I've utilized here. I've talked about that a little bit because depending on like your definition of breaker block, some people might also consider that like a mitigation, but it depends what time frame you're looking at, guys. So I wouldn't be too concerned with, oh, is that a breaker, is that a mitigation? I'd be concerned with what's it telling you about price action. So what this is telling me here is that we've initially, if you have a look down here, guys, we've initially broken past these two down close candles. That indicates a change in the state of delivery. Also, we've broken above this up close candle, meaning that potentially this up close candle is no longer acting as resistance, so maybe it's going to act as some kind of support. That's the theory, right? So we break above it, break a block, and then we return back into this bullish gap. What do? We propel higher. Perfectly, right? We respect the halfway of this bullish gap, we move higher. Price comes back down again, what's it do? Taps into this order block now. So notice how we're switching price action from one side of the curve, right? This side of the curve to that side of the curve. On this side of the curve, we're looking for up close candles to be respected as resistance. On this side of the curve, or this side of the curve, I should say, it's different. The down close candles are now acting as support, if that makes sense, right? So keep that in mind. So now we switch the down close candles, right? We trade back down into that, we push higher. We trade down back into this up close candle, we push higher, right? So you can look at breaker blocks, you can use the unicorn model to phrase high probability trades by potentially entering up in the move, as long as you still have that clear draw liquidity. So you have to be, mindful that above price action here, do we have equal highs? Do we have accumulation pockets? Is it a market maker buy model? is there a big imbalance above price action that we could seek, right? So down here, right, this is the first opportunity that you can use a unicorn setup. Up here, it's a larger time frame unicorn setup. So if you like to trade in the higher time frames, I'd encourage you when you're looking at these, look at those higher time frames if that's you, right? And then see how it's fractal. See how compared to the 1 minute, 2 minute, 3 minute, 4 minute price action is fractal, right? So again, it's really important to understand that price signatures are telling us different things. They're telling us, the strength or the weakness of price moving up or moving down. And we talked about that, right? So moving down, the up close candle should act as resistance. Moving up, the down close candles act as support, right? So we're flipping the switch. When do we initiate the flip of the switch? When we create this initial breaker block, right? When we create that initial breaker block, we have that unicorn setup, which is quite strong. Why is this a strong setup? Because again, we've disrespected now this resistance, being the up close candles, with a massive impulsive candlestick. And then if you compare this with time, whether it's a macro or silver bullet or a key, kill zone, that's when you get the highest probability unicorn models. It's not just at any random time. You need to make sure that you've got, a good sweep of liquidity. Have you swept time-based liquidity? A good liquidity target. Do you have equal highs, equal lows? Is it occurring during a macro or silver bullet? These are all things that when you have like a criteria or a checklist, these are going to make it more probable or, high probability that it's going to work out in your favor. Just keep that in mind as well. Again, when we move down, once we see these broken, we have an indication that price might want to reverse. So once we see this thing broken, price might want to reverse. That's important. The function of a bullish fair value gap when price is moving upward obviously is to provide support. Therefore, if we disrespect the bearish resistance and respect a bullish support, this is where the unicorn model can be a beautiful price signature. So what I'm talking about there, guys, if I just zoom in here, have a look. Have a look at price action. So just briefly to go that again, down close candle support price when we're going up, right? Up close candle support price in terms of resistance when we're going down. So as soon as we break above this up close candle, right, that indicates something. And then when we use that again as support, that also indicates something. So right here, we've got two things. We've got an order block in black and we've got a breaker block in green. Now we've got two PDRAs mixed with a market structure shift and a bullish fair value gap to take price higher. Price expands, now it starts respecting these down close candles. And you can see every time we trade back down, we expand higher. So as long as this keeps on happening, we expect price to move higher. Where should it move higher to? The next strong liquidity, the next imbalance, right? Until the next macro, until the next silver bullet session, whatever it is that you're trading, depending on the time frame that you're trading as well. So that's really important to keep in mind. Let's now combine concepts, right? So we've looked at a bullish example. Let's look at a bearish example and combine concepts together. And this is where things, might really start to make sense for you in terms of how you can apply these concepts, guys, because I think the most important thing when trading is draw on liquidity and narrative. You can enter from whatever PDRA you want, and different models, whether it's a market maker model or turtle soup model or unicorn model like I'm explaining here, they will be stronger or weaker based on a variety of factors. If you're taking notes, what are those factors? Time. Where are you in price action? Time. 2, what liquidity do you have to target? 3, what other supporting PDRAs are there apart from that pattern that you're looking for? So I'll talk about that here, and here's a really good example of a bearish situation using the unicorn model, but pairing this with other concepts to have a high probability unicorn setup. Because you might be curious as to why it doesn't work out. We'll talk about that here. So in the example below, right, I've outlined the same price structure as seen in the previous slides. In this case, obviously we're looking at a bearish example. So let's put all these concepts together, right? So notice now that there are two down close candles, right, that act as a breaker block. And let me just zoom in so I can explain what I talk about. It's not always one candle. It's the same with the concept of an order block, which if you guys want a video about order blocks and how you can use them, let me know. We can get like an advanced lecture on that. So for example here, right, these up close candles, when we break past that here, that whole thing is an order block, right? It's not just the top candle, the whole thing is the order block, right? So on a 1 minute chart, you've got 1, 2, 3, 4 candles. On a 4 minute chart, you'd have one candle, right? Depending on the time frame, you have different amount of candles. Same thing here. These are the two down close candles I'm talking about. On a 2 minute chart, it's probably just one candle, but on a 1 minute chart, if that's where you're executing on, it's 2. These are the last two down close candles before we have a sweep and then a market structure shift. So what I've marked out here is a similar kind of pattern. I've marked out A, B, C, and D, right? A is a high, B is a low. C is the swing high in this case that sweeps A. And then D is the swing low that's created that sweeps B, right? So once a market structure shift happens, you have D, and this is probably an easy way to explain it, right? You have these four components. You have A, B, C, and D. I'd encourage you to mark this out in your charts if you're not familiar with how to identify a breaker block. Now, where the breaker block is, it's these two down close candles. Notice how I've marked that out with these two black lines. That breaker block lines up with a bearish fair value gap here between this candle's high and this candle's low. This is a typical example of a unicorn model setup. It's also an example of the silver bullet model, a rate of liquidity, a market structure shift, and a return to a fair value gap. It's also an example of trading in silver bullet. It's also an example of using inversion fair value gaps. So that's what I'm going to talk about today, that you can pair all these concepts. So if you want to use a unicorn model, right, my thing that I like to do is I like to pair this with other concepts. Not just, oh yeah, I want to look for A, B, C, D. What are the PD arrays that are supporting my price action? Why should price get there and why should price go there? That's important to keep in mind. So let's get into it here. Again, there is more than just a unicorn entry model. There's additional confluences and they're important to consider. So for example, have a look at this. If I take that previous price swing, A, B, C, and then D somewhere down here, I've marked out two things. Firstly, I've marked out the OTE range, right? So if I did like a Fibonacci from this swing high to this swing low, look at where all these PD arrays sit. Look at them, right? This is 0.618, this is 0.786. That bearish fair value gap we drew out before, that lays in the OTE zone, which makes it a good place, right, to sell. Again, we talked about that in previous lessons. We also have this inversion fair value gap that lines up with this bearish gap. So now you've got multiple things lining up. You also technically have a balanced price range too. So even though, yes, this is a unicorn model, yes, it's about pairing these confluences, OTE, right? Sweeping time-based liquidity, inversion fair value gap, BPR, order block, supporting price, breaker block, supporting price. Where do these things sit in, right? Where do these things sit in? They sit in OTE. So we talk about it here, right? We have an inversion fair value gap, a sell-side imbalance, a breaker block, a change in the state of delivery when price closes below these up-close candles. We have a CISD, which is important. And again, it's ideal that the breaker blocks are nested with other PD arrays. It's ideal that these breaker blocks are nested with other PD arrays. We've talked about those PD arrays here. And if a breaker can rest within OTE, it's even better. Because as we know, OTE zones provide good selling and good buying points. So this is how you put it together. You don't just simply trade a pattern. Oh yeah, I'm looking for this, this, and this. Yes, that's at a base level. Then you put it together and go, okay, what are the confluences there supporting my price action? And look at our price closes too. Look at this. Look at where the bodies close. That is a key thing telling us that the wicks do the damage, the bodies tell the story. As ICT says time and time again, this is a classic example of that, guys. Look at where the bodies close. Look, we wick up into OTE, into the inversion, into the SIBI, into the order block, and then where do we close? We try again, we wick up, and we close down below. Right, so that tells us something, that the volume is resting here, right? The wicks are manipulating people. You know, people are going, oh, I want to go long, I'm going long, but realistically, prices are going to move lower. So keep that in mind. That's something else, you know, in terms of key pricing, which is how do the bodies close? That'll make this a stronger, you know, a stronger setup too. If price action, right? For example, let's go back here. If price action were to close all the way up here, and then the next candle closes above here, am I confident in the setup? No. Because why should price go up? Yes, there's an order block here, but there's a breaker. And then if you break above the breaker and close above it, that's not the unicorn model anymore. That means you're wrong and you should close the trade, right? So these are some little things that you should keep in mind. How you trade around these PD arrays tells you something. It's your decision how you manage your trade in terms of where do you put your stop loss, which you're going to talk about in a further video. But these are some key price signatures that I personally look out for, right? That I personally look out for. And we can even take a further example, guys, just to have a final example here. This here is from the London session, by the way, and this here, I think, is from the New York session. So it occurs in all sessions. It also occurs in the Asian session if you trade that, but personally, I don't look at that. So for us now, let's get into the last example. And again, if you like these videos, and I did this in the previous video, right? If you're still here, I really do support, you know, I really do appreciate the support. I put a lot of effort into making these PDFs, and I am going to be making a free Discord. So in the future, you know, the coming couple of weeks, these PDFs will be posted in there, right? So keep an eye out for that. But if you've made it this far, comment down below, comment macros in the comments, right? Because I know, right, all you guys that commented last time, I see ya, and I know you guys, you know, visit my videos, some from Discord, some are from YouTube, Telegram, whatever. Comment macros below if you're still here. Because I know a lot of people just, you know, watch 1 or 2 minutes and they skip on. But if you're still here, I want to know who is still watching my videos, because for you guys in the future, I'm going to do something special for you. So comment macros below, and then we're going to get into this example. So let's extend a little bit further, right? Again, high probability use, and forgive the spelling mistake, comes with more than just the pattern itself. Below is another high probability use case of the model. So in the image below, I want you to identify the breaker block. I want you guys to find the breaker block that I've marked out. I want you to find the bullish gap that I've marked out. And I want you to be able to see that, yes, we have a sweep of liquidity. Yes, we have a shift in structure. Yes, we return back into a fair value gap. Yes, that fair value gap lines up with a breaker block. Yes, price expands up. Yes, look at where the bodies close. All these things, right? All these things, the bodies are closing above, the wicks are doing the damage. All these things are talked about now lining up. But what else is at play? Before I give it away, what else is at play? What can you tell from this accumulation here? What's that tell you? What's this, and then this downwards move, and then this upwards move also look like to you? And let's get into it. So in this example, the unicorn model also matches up with the ICT concept, the power of 3. When you're able to merge and combine concepts, the trade becomes high probability. Notice you have this accumulation, as we talked about, followed by manipulation, and then we have distribution to the upside. Keep that in mind, and that there's what it looks like. Now you could even extend this further if you wanted to. Right, accumulation, manipulation, distribution, number 1. Number 2, we have the power of 3 combined with the typical, you know, silver bullet model, RAID, market structure shift return. Number 3, we have these 2 down close candles broken to the upside. That's a change in the state delivery. We also have, right, this bearish fair value gap broken above. That's an inversion. So how many PD arrays do you have here? You have more than 4. You have more than 4 confluences treating your trade as support. That is what you want when you're trading these unicorn models or any type of model, turtle soup, whatever. You want to have the most confluences possible, right, to phrase a high probability trade. If you guys want a video, right, on stop loss placement, if you guys want a video on, you know, narrative and things like that, let me know in the comments below. But until next time, guys, I hope you got value from this video. These are longer format videos, kind of like an educational lecture or module series. I got more coming, and until next time, guys, I'll talk to you then. Peace.